Morning everyone, welcome back to Morning Markets, where the team at True Potential discuss the events of the past 24 hours and how they have impacted asset markets. Today we'll focus in on jobs and data that we got from the US and also the Chancellor's package in the UK. Firstly, turning to the US, we get weekly data on initial unemployment claims in the US, and over the past number of weeks we've been discussing how that trend or the rate of improvement in that has been slowing. And yesterday we got further evidence of that with the weekly jobless claims number coming in at 870,000. Last week, if you remember, we discussed the number was 866,000, so a slight deterioration week on week, but again suggesting that the trend of improvement is slowing. We also had continuing claims numbers yesterday, which they were showing the ongoing improvement that we have seen since the peak of the unemployment rate in the US in the April-May time. And what did we see there? We saw that continuing claims fell to 12.6 million from 12.7 last week. And for some reference around that, if we go back to May time, the continuing claims number peaked at 24.9 million. So there you get a sense of the improvement that we have seen in employment trends within the US, albeit at this point in time that appears to be plateauing a little bit. And some of the forward indicators that we get from the likes of the purchasing managers indicators suggest that that will be challenged in the months ahead. And that is why over the past number of weeks we've been discussing the challenges that there appears to be in the US of moving forward with a further fiscal support package, in particular one that is targeted at employment and supporting those that are facing challenges from an employment perspective at this time. Contrast that a little bit with what we heard in the UK yesterday from the Chancellor, where he has made changes to the furlough scheme going forward. So it's a less generous scheme, I think is probably the best way to describe it. There is more onus on employers within it, but then there is the top up from the government to come through as well. It will be, I suppose, interesting to see over the coming number of weeks and months how that scheme is enacted in various different industries and whether it does provide the support that is envisaged by the government. We also heard of a number of other initiatives yesterday in terms of the bounce back loans, the repayment for those for those being extended from 6 to 10 years, and also VAT for the hospitality sector. The reduction from 20% to 5% will be in place for a number of months longer, I think through to the end of March next year versus originally it was January. So a number of things there in the UK to support or attempt to support the employment backdrop, and some changes within the rate of improvement in the US. Turning to asset markets yesterday, what did we see there? Europe, it was very much a continuation of the weaker performance that we saw in the US and Asia. That fed into the Eurozone market, with the Euro Stoxx 600 falling about 1% on the day, the FTSE down 1.3%. The US slightly different. What did we see there? Markets initially opened lower, following on from what had been happening in Europe, just rising concern about COVID-19 infection rates, curbs on activity, and what that would mean for economic growth. US opened lower and then traded up through the course of the day, with major indices closing positively. A lot of that appears to be attributable to some comments that we had from the Democratic Party talking about their willingness to re-engage in a discussion around a fiscal support package. So worth observing how the market reacted to that, reacted positively earlier in the week, and over the past couple of weeks as uncertainty around that has built, a bit of a negative performance. It just indicates how market participants are thinking about the need for further fiscal support to come through. I still think it's difficult. There's a wide gap between Democrats and Republicans, and also the timeline is quite challenging with the presidential election coming through on the 3rd of November. Whilst we've seen that choppy performance in equity markets, we haven't seen that move into other asset classes in the main. sovereign bond markets, corporate bond markets all remain relatively well behaved at this point in time, moving on the corporate side as you would expect, mirroring a little bit of the volatility that we're seeing in the equity side. In the sovereign bond market, pretty much no change really there, with particularly in the US, the 10-year hovering around that 66, 67 basis points yield level for the majority of the week. The other story, I suppose, for the week has been the dollar. Dollar strengthened so far about 1.5% over the course of the week against the basket of major currencies. And I think that just speaks to that increase in choppiness, volatility that we've seen in the equity market, and the dollar providing a little bit of a safe haven in that regard. That's it for today. Please join us again next week and do subscribe on the YouTube channel. Many thanks. Bye.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.